There is a general sentiment which is going on around in India right now that the rupee is falling significantly. So generally rupee depreciates per year by 4 to 5%, but in the last year it has depreciated by around 10%. And now RBI has pulled out a trick which is straight from the 2013 playbook of Mr. Raghuram Rajan. So what Sanjay Malhotra right now is doing is the same thing, at least in essence, which was done in 2013. So here if we see, in a 5-year period, the price of rupee has fallen by 22 rupees. So previously it was 73 rupees per dollar and now it has reached to 95.3 rupees per dollar. And there are multiple factors which have led to this, and in a way you can argue that for a country which is developing and you want to sell more exports, so a currency should be cheaper so that your exports are more competitive. But it creates a unique problem for India because you also have to import a lot of things, especially in our case we are importing a lot of oil. I think around 90% plus requirement of the oil is purely supplied by imports for India. So on June 9, I read a good article from Bloomberg, which was an opinion piece by Andy Mukherjee. And the title was "India has brokered a rupee truce, but not one piece." This explained a lot about the Indian rupee crisis of 2013. And what happened in 2013 is USA started so in 2013 the general idea that is said to be is a taper tantrum. So what USA said is that we will increase rates. Okay, so after 2008 USA had near zero rates and the world was used to that cheap money. So you borrow money in USA and then you try to invest it in developing countries like India or the other Southeast Asian countries. But the Federal Reserve let out a warning that 2008 is significantly back in the years now, 5 years back, and what we are planning to do is we will increase the rates. But this increase will not be a sudden increase, but instead it will be a tapered increase. So slowly, with every quarter, with every decision, the Fed will increase the rates. Now this caused panic in the markets because you need to understand that the money which was borrowed from USA was invested in companies like India. So what happened is all the foreign capital which was invested in India started to go back to USA. You want dollar, you will be selling your rupee assets. So your market is flooded with rupee and the value of rupee is tanking. At the same time, there is a demand for dollar, so the prices of dollar will increase. So this is what was happening and RBI had to step in because the rupee was falling at a pace which was not suitable. So what RBI did is that they gave an option for the local businesses to raise capital in US. So if you are a company in India, what you will do is you will go to USA and you will raise money in dollars. So your loan will be in dollars and this will come back to India and get invested here. So you are increasing dollars flow you're not increasing dollars flow, but you're bringing in dollars and you are exchanging dollars for rupee, and so rupee's demand is increasing. So rupee's value will increase. So this was the thing that took place in 2013 and this entire saga was called Taper Tantrum. Now, Mr. Sanjay Malhotra, the RBI governor currently in 2026, he is facing similar conditions. You have the rupee which is tanking and there are macroeconomic factors. You are dependent on oil imports and your oil pipelines are stuck at Strait of Hormuz. So you end up paying more for the oil. So if before war it was $35 per barrel and now it is around $100+ per barrel. So you are supposed to come up with more dollars, and for that you are flooding the market with rupee. You are exchanging it for dollars, so the rupee is falling, the dollar is strengthening. Now what happened in 2013, what the article says is India raised benchmark rate interest rates up to 8% and then Governor Raghuram Rajan had to leave them there for a year. And this was a big challenge because when you increase the rates, you are making borrowing more expensive. So if you are making borrowing more expensive, your economy pushes its brakes. So essentially you are applying a braking force on your economy because everything requires capital, and when capital becomes expensive, people will hold on to their investments. So if you want to buy a new home, your home loan is expensive. If you want to buy a new car, your car loan is expensive. If you want to purchase, if you want to raise capital for investing somewhere, even that becomes more expensive. So as a result, your entire economy, the growth plateaus or can also shrink a bit. But this is very important because when inflation is out of hand, there is only one tool which central banks have, that is you change the policy rate to try to bring inflation down. The other thing is that when your rates are increasing, okay, suppose your FD rates are say 3%. So this is not good enough incentive for people to invest their money. So people would rather spend it right now than save it. But every country requires capital, which requires savings. So when you are raising your interest rate to 8%, the 5% delta is an attractive enough difference which will make sure that people will save money. The other factor that also ties into this is if a company has to raise money, but there is very poor domestic savings, that also has a negative impact. So at that time, if your country is not saving enough, you are dependent on foreign inflow of capital. And if you're not getting any capital from foreign, then your businesses will not be able to raise funds and grow or develop your country. The third thing is that it was defending the currency. Because your rates are at 8%, what happens is suppose the US rates are at 3%. So people will again borrow, bring it back to India, invest. So you have dollars coming in, converting to rupee, which leads to your interest rate moving in a preferential direction. So this is the plot of RBI's policy rate versus Fed's fund rate. So you can see here, 2008, the rates have crashed near zero levels, and this is around 2013. The policy rate of US is very low, almost near zero, but this has increased a little bit. So this was a part where it was the taper tantrum was going on, and at this time India's rate was also high. So if you see in this part, we had a very less delta, and that same delta was increased wide open. And this was the main period where the US investors were flooding their dollars into the Indian economy. But what has happened recently after 2023 is that this rate has decreased a lot. Now this has multiple factors, mainly the unrestricted borrowing which is happening in US that has led to the increase in rates. So US has gone from again near zero to about 4.5%. Now the new changes which the RBI is trying to do is in the pretext of that the foreign institutional investors have been taking out money from Indian markets since last year. But now what RBI is suggesting is state-run firms and local banks to raise dollars overseas, bring them home and get a big discount on the hedging cost till September 30. They expect that this latest package will bring in at least $50 billion. There are some estimates which are ranging from $25 to $50 billion. And these funds may come in via the bond market where foreigners have been given tax breaks also. So recently the government had announced some tax breaks for foreign institutional investors if they are investing in government bonds. Now RBI is giving us a similar concession on hedging this time around, which is roughly 3% a year. And the Monetary Policy Committee has also decided to hold the repo rate at 5.25%. And the way we saw that the gap between Indian rates and US rates is narrowing a lot, because Fed's target range is 3.5 to 3.75 and we are at 5.25%. And it is also expected that the Fed will move towards a higher policy rate. Okay, so there is a concept of the impossible trinity in economics, which is the Mundell-Fleming trilemma. It states that an economy cannot simultaneously maintain all three of its following policies. You cannot have free capital flows, fixed exchange rate, and sovereign monetary policy at once. What you have to do is you either select two and then sacrifice the third. So you can either have, say, free capital flows where foreign money is entering and exiting freely, and you can have a fixed exchange rate. But what is happening is you are sacrificing independent monetary policy. Your capital is flowing freely, and so interest rates must match that anchor to keep the exchange rate stable. An example for this is the Eurozone countries. The other way is that you keep your fixed exchange rate and you also manage a sovereign monetary policy where you are setting independent domestic interest rates. So if your economy is suffering, you can lower them. If your economy is running hot on inflation, you can increase the rates. But here you are sacrificing free capital flows. But to ensure that capital does not flee out of your country randomly in a very spontaneous manner, you will have to implement strict capital controls to stop money from entering or leaving. This is an example with China. The next possible combination is you have free capital flows and you also maintain a sovereign monetary policy. So here you are sacrificing a fixed exchange rate. You can set your own interest rates, but the free flowing market forces will decide what your currency's value will be. This is an example of most developed countries like USA, Australia. You have money coming in, coming out, there are very few restrictions on it, and also you have your sovereign power to manage your policy rates. This is the ideal situation because there is the least interference from the government. Now what generally happens is, suppose this is a current situation where borrowing in India will cost you 8% and borrowing in US will cost you 4.5%. So suppose a company has borrowed from USA and now it has to take an insurance hedge so that in the future, say the rupee crashes and that erodes the arbitrage which is available here. So currently what is the arbitrage here? It is around 3.5%. So there is a 3.5% margin or a spread. But if the rupee crashes more than expected, this could be wiped off, and you could be better off by raising money in India. To avoid that, what they do is they will buy an insurance hedge so that even if rupee falls much more than expected, they are saved. In this case, your hedge becomes 4.5 plus 3%. So say this is 7.5 and you have 8%. So your margin is only 0.5%. But now what RBI is saying is that they will bear the cost of hedging. So say that they bear half of it, which is 1.5%. So now your new spread is 4.5 plus 1.5, that is 6%. And you have 8% from India. So your spread or your advantage is of 2%. This is the fundamental thing that RBI is trying to achieve, to bring in more dollars into India so rupee strengthens or at least stabilizes. Yeah, so that was a recap where we are seeing the same things from 2013's Taper Tantrum being repeated in 2026.